Hello everyone, I'm Devon Coombs, CPA, MBA, and today I'm going to cover ASC 606, Step 3, determine the transaction price. So the point of this video is just a high-level overview of the riskiest concepts for this topic, and I'll try to keep it a little interesting. But if you want a deeper dive, just comment below. Feel free to subscribe, and I'll try to make videos that you'd comment on. I'll try to cater to your needs. So main topics here I want to talk about. First off, what is the transaction price for a contract? So when we're talking about a transaction price for a contract, specifically what we're looking for is we're looking to figure out what is the total dollar value of that contract. And this might seem simple. For a simple business, we might say, hey, I'm going to sell you a software license, and that software license is $1,000 for the year. Well, the $1,000 for the year is the transaction price. That's relatively simple, right? But we can make much more complex elements in explicitly like enterprise level contracts or much larger businesses, but they get pretty complex in basic businesses as well. So what if you have $1,000 a year contract, but the customer signs up for 3 years, but has a termination right to cancel at the end of every year? And this is pretty common in gym memberships, right? Where you can like lock in a price. Let's say you pay $300 a month for your family for a gym membership. That price is locked in as long as you have the contract. And you have to renew the contract every single year. Maybe the price is locked in for 3 years, but you can cancel the contract once every year, right? And so the question is, well, is that $300 contract or is that a $900 contract? So this is the concept of termination rights in contracts that really impact the contract duration and the contract transaction price. So when we're thinking about this, we really should be considering, well, can the customer terminate for convenience? Right? Is it at the customer's option or is it at the company's option? And is there a penalty associated with the termination? And is that penalty substantial? So is that penalty substantial enough to deter the customer? So, for example, the gym membership, you have to spend $300 to cancel the contract. The contract's only $900. Customer's probably not going to want to pay that, and so they're probably just going to keep the 3-year contract. It makes more sense to keep it than to pay the penalty. And so that's this concept of substantive penalty and termination rights. And that's just one idea of how that can impact your transaction price. And the reason this is so important is because it goes into a company's disclosures. And so you need to disclose all of the future transaction price that you expect to recognize revenue against over the average contract life on your financial statements as a public company or any company that needs financial statements. So this is a really sticky issue where you really need to review your contracts and see, well, do we have explicit termination rights? Another concept is variable consideration. So what if there's refund rights in the contract? So let's say it's the gym membership or a software license, but if the customer doesn't use a certain amount of seats for the software license or doesn't use a certain amount of data, they can get a refund or credits or a refund against that contract for, let's say, $100. Well, then you have to estimate that variable consideration, this refund, and adjust the transaction price on day one to make sure that we're recognizing revenue accordingly. And so this topic can really confuse a lot of people. Like, how do you recognize and estimate a transaction price variable consideration component? And there's two methods. There's the most likely method, which is you just say, well, most likely is either 100% or 0%, like this binary method, or there's a method where you take the weighted average, right? So you can determine, looking at your historical accounts, what's the weighted average likely amount that you're going to accrue for a refund, and then apply that to your specific contracts. And you could either do that at a portfolio level or you could do that at the contract level, as long as it's consistently applied and it meets all of the other revenue standard considerations and it's applied consistently in your policy. And so this variable consideration element is pretty tricky, and it can go both upward and downward, right? If a customer might pay you more for your contract, you have to estimate that upside as well. And if the customer might pay you less, you might have to estimate that downside. And then you're essentially going to call that revenue recognition, all that future revenue recognition, that transaction price, as your backlog disclosure. That's going to be your backlog disclosure, and you're going to report that. And then you're also going to have to make sure that you're collecting against it and allocating to all the underlying performance obligations. So this is where you really need an expert reviewing your contracts to make sure when you're writing your contracts that it doesn't overcomplicate your accounting systems. And at the same time, you want to make sure that you're maximizing your revenue and backlog in a way that's applicable and in accordance with GAAP. And so these are just some concepts about transaction price that I want to highlight for everyone. I think they are it's a very highly technical area. And so if you have any questions, just comment below, subscribe, and I'll make some more videos about more explicit examples if anyone has questions related to this. Thank you.